TotalEnergies just delivered an absolute monster of a Q1 beat, completely blowing past consensus estimates. We are looking at adjusted net income of $5.4 billion, which is up 41% from last quarter. Cash flow from operations sits at $8.6 billion, a 20% jump. And adjusted fully diluted EPS, the metric that actually moves the needle for your portfolio, clocked in at $2.45, representing a massive 42% surge. The stock immediately caught a bid on the open because management took that cash pile and handed it straight back to the market.
Oh, absolutely. I mean, they've followed up those earnings figures instantly with a 5.9% increase in the interim dividend, pushing it to 0.90 euros per share. Plus, they locked in the continuation of a $1.5 billion share buyback program for the second quarter.
Right, which signals intense confidence in their near-term liquidity. And their Q2 macro guidance tells us exactly what kind of environment is funding those returns. They expect crude oil to hover around $100 a barrel and European gas to stay elevated at $14 to $15 per MB2.
Yeah, the broader operating environment is just exceptionally volatile right now. But a structural commodity squeeze like this, it's highly lucrative if a company possesses the integrated logistics and downstream capacity to capture the physical margins.
Which perfectly establishes our mission for this deep dive. As two financial analysts, we are tearing apart this TotalEnergies Q1 earnings report for you. We need to figure out the operational mechanics of how management is navigating some truly extreme geopolitical turbulence.
Exactly.
We're going to isolate the segment performance, unpack where these multi-billion-dollar margins are actually being generated, and, most importantly, expose the hidden balance sheet risks you need to have on your radar before placing a trade.
Because, I mean, the entire report hinges on one dominating macroeconomic reality, right? The ongoing conflict in the Middle East. It has completely scrambled the global supply-demand balance.
Yeah, totally.
In their commentary, management explicitly noted that the conflict has essentially wiped out the global hydrocarbon surplus scenario that futures markets were pricing in at the beginning of 2026.
And you see the localized damage of that conflict immediately in their upstream metrics. I mean, TotalEnergies lost roughly 100,000 barrels of oil equivalent per day in the first quarter.
Wow.
Yeah. And the forward guidance is pretty stark. As of late April, production shutdowns in Qatar, Iraq, and offshore facilities in the United Arab Emirates represent a staggering 15% of the company's total global production.
Right, and having 15% of an energy major's global output forcibly shut down, that is a logistical nightmare. In a normalized macro environment, taking that much volume offline would completely crater a quarter's revenue and send the stock tumbling.
So let's isolate that production paradox for a second, because they have 15% of their production offline, yet they somehow reported a 4% year-over-year organic production growth.
Yeah, it's wild.
Think of their global operations like a highly decentralized municipal power grid. If a major transformer blows in one city, in this case the Middle East, the system doesn't just black out. It instantly draws extra juice from generators in other regions to keep the lights on, and somehow ends up running brighter than before.
So where do they draw that extra capacity from?
Well, they pulled that capacity from a multi-year project pipeline that finally matured. They basically absorbed those localized Middle East losses through the aggressive ramp-ups of new offshore growth engines.
Okay, like which ones?
The earnings release specifically highlights the Lapa Southwest project down in the pre-salt basin of Brazil and the onshore Mabruk project in Libya. Because those massive assets came online and hit peak flow rates, total first quarter oil and gas production actually climbed to 2.553 million barrels of oil equivalent per day.
See, that is the ultimate defense of geographical diversification for an investment portfolio. If you only operate in one basin, a regional flare-up wipes you out entirely.
Oh, exactly. But by spreading capital expenditure across Brazil, Africa, and the North Sea, they insulated the balance sheet from a localized shock. And not only that, they positioned themselves to sell those new barrels into a price spike caused by that very same shock.
Right, so let's trace how that translates to the income statement. If we look at the traditional exploration and production business, so the E&P segment, it delivered $2.6 billion in adjusted net operating income.
Which is a huge jump, right?
Yeah, a 43% jump quarter to quarter.
And the primary catalyst for that E&P jump is just the raw commodity price. We saw average liquids prices increase by $12.4 per barrel over the quarter. But the report also points to this price lag effect in the United Arab Emirates that artificially boosted their realized revenue.
Right, the price lag. That essentially means their offtake contracts dictate that the price they charge buyers today is calculated based on the average market price of the previous month or quarter.
So when crude prices spike vertically like they did in Q1, there is a built-in delay before a company's realized contract revenue catches up.
Exactly. But once that lag rolls over into the new pricing tier, the margin expansion is dramatic. You have highly elevated contract prices colliding with the accretive production volume from Brazil and Libya.
They also executed some heavy portfolio optimization to, consolidate their strongest assets. They completed the merger of their UK upstream business with NEO NetXT.
Which is a massive move.
It is. That created the absolute largest independent oil and gas producer in the UK North Sea, with TotalEnergies holding a 47.5% operating stake. And they paired that by announcing two new deepwater hydrocarbon discoveries on the Moho field off the coast of Congo.
Consolidating legacy assets in the North Sea while hunting for new reserves in Africa really shows a dual-track strategy. But, to truly understand how they're monetizing this global volatility, we have to look past the crude oil wells. We need to analyze the integrated LNG segment.
Right.
Liquefied natural gas generated $1.3 billion in adjusted net operating income and a massive $1.8 billion in operating cash flow.
And that cash generation is underpinned by a 12% increase in physical LNG production. But, generating $1.3 billion requires more than just extracting gas and chilling it into a liquid.
Oh, way more. TotalEnergies operates an integrated model. That means they control the physical molecule from the extraction wellhead through the liquefaction plant onto the specialized shipping vessels and all the way to their own trading desks.
So they aren't just passively selling gas at a fucked daily rate.
Not at all. They're
Ew.
actively trading the geographical arbitrage. Like, if a ship leaves a terminal bound for Europe, but mid-ocean, the Asian spot price spikes due to, say, a sudden heat wave.
They can just reroute it.
Exactly. Their trading desk has the logistical authority to reroute that tanker, capture the premium margin in Asia, and fulfill their European contractual obligation with a different asset from another facility.
Wow. That level of logistical control is exactly why they are aggressively locking in future supply from lower-risk jurisdictions. They finally resumed construction on the massive Mozambique LNG project after extended security delays.
Right. And more importantly, they secured a preliminary agreement for a 20-year, 2 million tons per year offtake from the Alaska LNG project.
Securing 2 million tons annually out of Alaska is a massive strategic anchor. It gives their trading desk guaranteed, stable volume from a politically secure region. They can use that reliable Alaskan supply to optimize margins across the globe for the next 2 decades. It's essentially a hedge against the exact kind of Middle East disruptions we're seeing today.
Definitely. But, extracting the commodity is really only half the equation. To see how an integrated major fully monetizes a $100 oil environment, we have to follow that crude into their downstream segment, specifically refining and chemicals.
Oh man, the refining numbers.
Yeah, this segment was the absolute cash cow of the quarter. It brought in nearly $1.6 billion in adjusted net operating income. That is an incredible 60% surge quarter to quarter.
And the critical metric driving that surge is the ERM, or the European Refining Margin Marker. Basically, refineries make money on the crack spread, the difference in price between the raw crude oil they buy and the refined products like diesel and jet fuel they sell. In the first quarter of 2025, that margin marker sat at a historically weak $3.9 a barrel this quarter. The ERM rocketed to $11.4 a barrel.
Which is just insane. A refining margin tripling year over year usually points to a severe bottleneck. Global demand for refined products remained incredibly robust, but the geopolitical supply shocks really constrained how much diesel and gasoline was actually hitting the physical market.
Which completely blew out the premium refiners could charge. And TotalEnergies made sure their infrastructure was physically ready to capture every penny of that premium. They reported that their global refining units recovered full operational performance, running at a utilization rate of over 90%.
Right. They ramped up their heavy machinery to maximum safe capacity just in time to capture what management explicitly called exceptional margins in March.
Yeah. High utilization meaning historically high margins. It's the textbook definition of a downstream windfall.
It really is.
But let's contrast that $1.6 billion refining windfall with their integrated power segment. Because this is where the narrative gets a bit complicated. TotalEnergies heavily markets itself to the public as an evolving multi-energy company leading the green transition.
Right, they push that angle hard.
Yet the integrated power segment delivered $545 million in adjusted net operating income. That figure is completely flat year over year and actually slightly down quarter to quarter.
Well, the earnings report did highlight significant capital deployment in that space.
Yeah.
They completed a major transaction with EPH, which is a prominent Czech energy group, to accelerate their gas-to-power integration strategy across Europe.
Sure.
And they also aggressively expanded their renewable footprint.
hmm
They noted they commissioned 8 gigawatts of renewable power generation over the last 12 months.
And look, commissioning 8 gigawatts is a massive engineering feat. But as an analyst looking at the income statement, I have to challenge the overarching narrative here. The numbers show they are printing absolute fortunes on old-school petroleum refining, while the renewable power segment's income remains completely stagnant.
Yeah, that's true.
I mean, this integrated power unit isn't even targeting positive free cash flow until 2027. We really have to ask if this segment is primarily functioning as a green halo for public relations, while the traditional fossil fuel cash cow continues to do the actual heavy lifting for the dividend.
I get that skepticism, but building a utility-scale global power business from scratch is one of the most capital-intensive endeavors in the modern economy. The financial profile of renewables operates on a steep J-curve.
Right, lots of upfront cost.
Exactly. You deploy billions of dollars up front to secure land, buy turbines, lay transmission lines. During that build-out phase, income naturally looks flat or negative. The massive cash flow generated by $100 oil and those $11 refining margins is exactly the capital engine allowing them to finance that 8-gigawatt expansion. And they're doing it without loading up the balance sheet with crippling high-interest debt.
Okay, financing future transition goals with today's crude margins makes theoretical sense, but analyzing today's cash reality requires us to look at the underlying financial health of the enterprise. We need to evaluate the balance sheet.
And honestly, the foundational metrics remain incredibly robust. Their gearing ratio, which measures net debt as a percentage of total capital, stands at a very conservative 15.5%. Return on equity is at 14.4%, and return on average capital employed, or ROACE, sits at 12.7%.
Let's define why RAC matters for an energy major. It tells us exactly how efficiently management is deploying its massive capital base to generate actual profit. A 12.7% return in a highly cyclical, capital-heavy industry proves they are allocating resources effectively, rather than just throwing cash at inefficient mega projects.
Definitely. Those efficiency metrics are solid, but they mask a severe liquidity drain buried deeper in the cash flow statement.
Right, here we go.
Operating cash flow completely plummeted in Q1. It dropped 68% quarter to quarter, down to just $3.36 billion.
This is the glaring anomaly of the report. We established earlier that cash flow from operations, when you exclude working capital changes, was actually up 20%. So the culprit dragging the headline number down is a staggering $5.1 billion increase in working capital requirements. Why is $5.1 billion in cash suddenly paralyzed on the balance sheet?
Well, working capital bloat is a critical, often overlooked risk when investing in commodity producers during a price boom.
Okay, unpack that.
When crude oil surges to $100 a barrel, it doesn't just mean wider profit margins on the income statement. It means the day-to-day mechanical friction of operating the business becomes exponentially more expensive.
Let's break down the actual mechanics of that $5.1 billion drag.
Sure. Roughly half of it, about $2.5 billion, is driven by standard seasonal patterns. During the winter months, their downstream marketing and services division physically purchases more inventory to meet European heating demand. Buying that inventory temporarily drains cash until the products are sold to the end consumer.
That makes perfect sense.
But the remaining $2.6 billion is directly tied to the impact of surging hydrocarbon prices, artificially inflating the accounting value of their resting inventory.
Oh, I see. So imagine a massive global pipeline network and a fleet of supertankers holding tens of millions of barrels of crude oil at any given moment. When oil trades at $70 a barrel, that physical inventory ties up a certain amount of capital.
Yeah.
But when the global market price spikes to $100, the replacement cost of that exact same physical volume surges. The accounting value of the inventory spikes, which registers mathematically as a multi-billion-dollar drain on working capital.
The cash literally gets trapped in the pipes and the storage tanks. Yeah. It's basically a hidden tax on liquidity during a price shock. Now, that cash isn't destroyed. TotalEnergies will realize that revenue when the physical inventory eventually flows out of the system and is sold to a customer. But in the short term, it creates a massive crater in operating cash flow.
Which perfectly illustrates why maintaining that conservative 15.5% gearing ratio is such a vital defensive strategy. If a company is overleveraged with debt, a sudden $5 billion working capital swing could easily trigger a liquidity crisis.
Oh, absolutely.
TotalEnergies passed the stress test because their balance sheet had the elasticity to absorb the shock without threatening the dividend payout.
And looking ahead to the second quarter, management's forward guidance suggests these elevated prices and liquidity requirements are going to persist. They specifically noted that safely restarting complex production facilities in the Middle East typically requires a 2 to 3 month lead time.
Meaning supply stays tight.
Exactly. Consequently, they expect global oil supply to remain constrained, keeping prices anchored right around that $100 mark throughout Q2.
And the natural gas market appears equally constrained. The report flags that European gas storage facilities exited the winter heating season at a 5-year low, sitting at just 25% of total capacity.
A 25% storage level heading into the summer injects severe panic into the energy markets. Europe has a hard physical mandate to replenish those underground salt caverns before the next winter arrives. Doing so requires purchasing massive volumes of spot market LNG.
The problem is they are competing for a finite number of specialized LNG shipping vessels against Asian markets, who are also aggressively buying gas to meet their own summer cooling demand.
Right, it's a global bidding war.
That intense cross-continent bidding war for limited maritime supply is exactly why TotalEnergies expects European forward gas prices to find a hard floor at around $14 to $15 per MP2. Which, just as a reminder, stands for million British thermal units, the standard pricing metric for gas contracts.
And due to the pricing lag effect we discussed earlier, management anticipates their own average realized LNG selling price to settle around $10 per MB2 for the second quarter. So the macro environment remains incredibly supportive for their upstream extraction and their global trading desks. Excluding the ongoing localized impacts in the Middle East, they project Q2 organic production to continue growing by roughly 4% year over year.
However, you definitely need to recalibrate your expectations for the downstream segment. Management explicitly warned the market not to expect a repeat of that $1.6 billion refining windfall.
Yeah, that was a one-off peak.
Right. They're projecting their global refinery utilization rates to drop significantly, falling to between 80 and 85% in the second quarter.
And that drop in utilization is driven by planned operational downtime. They cited a strategic capacity reduction at the Essatorp refinery in Saudi Arabia. But more significantly, they are initiating a 2-month turnaround at the massive Donge refinery in France.
So a turnaround is industry terminology for a heavily scheduled massive maintenance event. They essentially take the entire refining facility offline, dismantle the complex cracking units, clean the pipes, replace catalysts, and upgrade the technology.
It's a huge undertaking.
It really is. It requires thousands of contractors and completely halts production for weeks, which will severely compress their downstream margins for Q2.
So the upstream cash generation from $100 oil will have to compensate for that downstream maintenance drag.
Which brings us to a really specific line in management's forward commentary that warrants intense scrutiny. They confirmed their yearly net capital investments will remain disciplined at $15 billion. But they added a crucial caveat. They said, the company is evaluating options to accelerate short-cycle investments to capture current hydrocarbon price environment.
Yeah, accelerating short-cycle investments during a price spike reveals a very distinct shift in their capital allocation strategy.
So let's define the mechanics of a short-cycle investment. Instead of spending 5 years and $5 billion exploring a new deepwater basin and building a massive offshore platform from scratch, a short-cycle project relies on existing infrastructure.
Right. It usually involves drilling what they call an infill well.
Basically putting a new hole in the ground right next to a mature producing well and tying it directly into the current plumbing.
Exactly. A tieback or an infill well can be engineered, drilled, and brought online in a matter of months rather than half a decade. It is exceptionally capital efficient and begins delivering free cash flow almost immediately.
Makes sense when prices are high.
When oil is sitting at $100 a barrel, management's primary fiduciary duty is to maximize shareholder return. Leaving highly profitable, easily accessible oil in the ground when you already own the surrounding infrastructure. That is a nearly impossible strategy to defend to institutional shareholders.
Honestly, I view this short cycle acceleration as a strategic sugar rush. They see $100 oil, and they are pivoting away from complex, multi-year greenfield projects to chase the immediate high-margin hit of rapid fossil fuel extraction.
It really highlights the core friction of the integrated model. I mean, they're balancing the immediate aggressive demands of a supply-constrained geopolitical crisis against a multi-decade green transition strategy. Right now, the geopolitical crisis is dictating the capital flows, and the legacy fossil assets are funding the entire enterprise.
Which leaves us with a final provocative thought to mull over regarding that exact capital strategy. If one of the world's largest, most sophisticated energy companies is explicitly looking to accelerate short-cycle fossil investments today to capture peak pricing, what does that internal capital pivot truly signal about their private expectations for the speed of the green energy transition versus the geopolitical reality of the next decade?
It's a fascinating question.
It really is. To stay on top of the numbers that move your portfolio, make sure you follow the show for our daily earnings coverage.